Okay, so let's start. We want to start revising. We want to start revising now. So I want to start revising this first topic. And the topic we want to revise is called impairment of assets. Impairment of assets. So let me review it first before we do a question. Now, whenever a company wants to test whether their assets have suffered an impairment loss or not, whenever a company wants to test whether their assets have suffered an impairment loss or not, you normally have to compare, as a company, you have to compare the carrying amount of that asset with an amount we normally call the recoverable amount. That to know whether an asset has suffered an impairment loss or not, you compare the carrying amount of that asset with an amount we call the recoverable amount. Then we normally say, if the carrying amount of the asset is higher, if the carrying amount of the asset is higher than each recoverable amount, then we say that asset has suffered. For example, if the carrying amount of your asset is 1 million and you calculate the recoverable amount of that asset and you find it's 800,000, then we say that asset has suffered an impairment loss of 200. That asset has suffered an impairment loss of 200, so that asset should be reduced in value by that 200. Because you debit P&L account with the 200, it's a loss, and you credit the asset. So the condition is an asset is said to have suffered an impairment loss if the carrying amount of that asset is higher than the recoverable amount. The other point is, how do you determine the recoverable amount of an asset? But before I talk about the recoverable, of course, carrying amount is that amount. Listen, carrying amount of an asset is the amount at which an asset appears in the books. By the time you are testing for impairment, what is the net book value? That net book value of the asset is what we are calling the carrying amount. The amount at which an asset appears in the books, that is the carrying amount. But what is the recoverable amount? I do hope you remember how to compute the recoverable amount of an asset. That normally, to calculate the recoverable amount of an asset, you compare two values for that asset. In other words, you calculate two values for that asset, whichever the asset, you normally have to calculate two values. One of them is what you call the net realizable value, and the second one is what we call value in use. So you calculate those two values for that particular asset. How much is the net realizable value and how much is the value in use of the asset? Let us assume that you computed the net realizable value, you found it was 800,000, and you computed the value in use of that asset and you found it was 700,000. Listen, whichever of the two is higher, that's what we normally consider to be the recoverable amount, So we normally define recoverable amount of an asset to be that amount which is considered to be the amount that is considered to be the higher of. The amount that is considered to be the higher of, one, net realizable value, and number two, value in use. Whichever of the two is higher, that is what you consider to be the recoverable amount. So in this scenario, the recoverable amount will be how much? 800, because it is the higher of these two values. Okay? The other question is this: how do you determine the net realizable value of an asset? How do you determine the net realizable value of an asset? Of course, I hope you remember that to get the net realizable value of an asset, you normally take the selling price of that asset, take the selling price of the asset, and you minus any costs to sell. You minus any cost to sell. You take the selling price of that asset, you minus any cost to sell. Of course, the selling price is the same as the market value. For you to realize this 800,000, maybe the selling price of that asset was 1 million. That was the market value of that asset. But for you to get that 1 million, you have to incur a cost to sell. And maybe the cost to sell is 200,000. So it means, therefore, effectively, when you shall sell the asset, you will sell it, yes, for 100,000, 1 million, sorry. You will sell it for 1 million, but effectively you will realize 800,000 because you will sell, yes, for 1 million, but the cost of realizing that 1 million is 200. Okay? Maybe there is transport cost to take the product or that asset where it will be sold and so on. Whatever the cost to sell. Okay? We are saying that's how you determine the net realizable value. What about the value in use? How do you determine the value in use of an asset? To get the value in use of an asset, you remember we were saying, if, for example, you are testing your impairment by end of this year, you have to ask yourself, what are the cash flows that are we expecting to generate in the future from the use of that asset? You, as a company, by end of this year, you want to compute the value in use of this asset. So you have to get the projected future cash flows that will be generated from the continuous use of the asset. Once you get those future cash flows, then we said you get the present value of those cash flows. Get the present values of those cash flows. Once you get the present value of the estimated future cash flows, that gives you what we call the value in use. So we normally define value in use to be the present value of the estimated because these are future cash flows. Present value of the estimated future cash flows. Once you get that, that becomes your value in use. Okay? Now, the accounting standard for impairment, which is normally IAS number 36. The accounting standard for impairment is IAS number 36. Listen, that accounting standard has specified which components of these cash flows should be discounted in order to get the value in use. The accounting standard gives 3 components of the cash flows which you as a company should use in the determination of the value in use. One of the components of the cash flows is any cash inflow that will be generated from the continuous use of the asset. As you keep using this asset in the future, what are the cash inflows that will come in as you continue using the asset in the future? That's one of the components. Number 2, for example, let us assume we are dealing with a machine, and maybe somewhere in the 4th year or 5th year, you as a company, you will need to spend some money for maintenance of that machine, or you think you are projecting that machine may require some repairs in the year 5 years or 2 years from now. So some cash flow in the future will be an outflow, not an inflow. So another component of the cash flows that should be discounted is any cash outflow that will necessarily be incurred. Any cash outflow that is necessarily incurred in order to generate future cash flows. In other words, you have projected that as a company, in the 3rd year from now or 4th year from now, we shall have to spend some money for maintenance of that machine. Why do we have to spend some money for maintenance? So that that machine can also be used in the more in the future. Okay, so that's what we're saying. So if somewhere you project that you will have to incur some cash outflow, that's another component of the cash flow that should be discounted in the determination of the value in use. The last one is at the end of the useful life of that asset, whichever the end of the useful life, normally that asset will have to be disposed. And whenever you dispose of an asset, in most cases, you normally sell it. Okay? So you get some cash flow. Alternatively, it may be that for you to dispose that asset, maybe it's a machine, you have to dismantle it. So instead of you receiving some money in the disposal time, you may be the one spending money to dismantle the machine. But at the end of the useful life of that asset, there will be some either cash inflow, which is in most cases cash inflow, or it could be a cash outflow because you are the one spending to dismantle that machine when it has come to the end of its useful life. So the third component of the cash flow is any cash received or paid at the end of the useful life of that asset due to the disposal of the asset, Okay? So sometimes an examiner will give you some cash flows so that you determine the value in use. So that's one of the small tricks in this question or in this kind of a topic, how to get the value in use. I have said you get the present value of the future cash flows. Okay? So most of your questions, not most, some of your questions, you are given that we project to receive this much year 1, year 2 from now, this much year 3 from now, 4th year, and so on. Then maybe somewhere in the question they tell you in the year of disposal or in the final year, we expect to sell the machine for this much. So you don't forget that that amount you are going to sell the machine for is a requirement. It must be part of the amount to be discounted in the determination of the value in use. Okay? Another point is, I hope you know the formula for getting the discounting factors when you are getting the present value. It is obviously 1 plus r to the power of negative n. When you have these future cash flows and you want to get their present values, if the examiner does not give you the discounting factors, you know the formula is 1 plus r to the power of negative n. Are you there? Good. So I think I've reminded you this, what is important in this topic. So I want to project a question. So that we do it together. I want to project a question. We do it together. Let me project a question so that we do it together now. Let me also share it in the group. Okay, I've shared it. But let me project it also. There it is. I want us to tackle it. The one I've chosen is more detailed than the one which was brought in your exams. In our normal class, we did a November 2020, I think so. We did a November 2020. And the one we did has a similar concept, but this is a bit more detailed. But the one we did in the normal class was November, I think, 2020. So let me read this question now. Okay. It says, the question says, The question says, number A, the objective of IS number 36, impairment of assets, is to prescribe the procedure that an entity applies to ensure that its assets are not impaired. Required. Explain what is meant by impairment review. Your answer should include reference to assets that form a cash generating unit. Note, you are not required to describe the indicators of impairment and how to allocate losses to indicate. You are not required to describe the indicators of impairment or how impairment losses are allocated against the assets. So that is just a theory part of the question. What they're asking you is, what is impairment review? Of course, we have already answered it. What's impairment review? We have said, when you want to know whether your asset has suffered an impairment loss or not, what do? You compare the carrying amount of your asset with its recoverable amount. Then we have said an asset is said to have suffered an impairment loss if the carrying amount of that asset is higher than its recoverable amount. Okay, that's what we are saying. So therefore, we are saying an asset. When you're asked to explain what's impairment review is the process. It is the process of determining whether an asset has suffered any impairment loss. We are saying an asset is said to have suffered an impairment loss if the carrying amount of the asset is higher than its recoverable amount. That's what we call impairment review. Of course, you could have gone further and explained what is recoverable amount, what is carrying amount, but in that case, the examiner will not require. What he wanted you to say was impairment review. It's the process of determining whether an asset has suffered an impairment loss or not. How? By comparing the carrying amount of an asset with its recoverable amount. And you can say an asset is said to have suffered an impairment loss if the carrying amount of the asset is higher than its recoverable amount. Good. Now, the question goes further, and it was telling you, you are supposed to include reference to include assets that form cash generating units. I'm going to explain that in a short while. The next part of the question touches it. So I want to leave part A, part of those questions. I want to leave part of that question because in the lower part of the question, there is something we shall discuss concerning cash generating unit. Okay. So now let me go to part B of that question. Let me now go to part B of that question now. That is why I wanted us to do. Let me read part B of this question. Then for the remainder part of part A, I'll finish it as we do the other question on cash generating unit. Okay. So number B says, I'm reading number B now. Number B says, number B1, Telpath acquired an item of plant at a cost of 800,000 on 1st April 2010 that is used to produce and package pharmaceutical pills. The plant has an estimated residual value of 50,000 and an estimated life of 5 years, neither of which has changed. Telpath uses straight line depreciation. On 31st March 2012, Telpath was informed by a major customer who buys products produced by this plant that it would no longer be placing orders with Telpath. Even before this information was known, Telpath had been having difficulty finding work for this plant. It now estimates that the net cash inflow and from the plant for the next 3 years will be, by end of March 2013, we expect to generate 220,000. Figures are in thousands. By 31st March 2014, we expect to generate 180. And by 31st March 2015, we expect to generate 170. Next paragraph. On 31st of March 2015, that's at the end of the year, that is according to this, by the end of that third year, the plant is still expected to be sold for its estimated residual value. Telpath has confirmed that there is no market to which to sell the plant. Then you are told Telpath cost of capital is 10%, and the following values should be used. You are given the one value of 1 shilling. At the end of year 1, it is 0.91. By end of year 2, that is 0.83. By end of year 3, it is 0.75. So those are the discounting factors the examiner has given you at a cost of 10%. Okay, good. That's number B1. B2. Number B2 says, Telpath owned 100% subsidiary, a company called Tilda, that is treated as a cash-generating unit. On 31st March 2012, there was an industrial accident, a gas explosion that caused damage to some of the Tilda's plant. The assets of Tilda immediately before the accident were goodwill, 1.8 million, the figures are again in thousands, patent, 1.2 million, plant, a factory building, 4 million, plant, 3.5 million, cash, 1.5, totaling to 12 million. And they are saying, as a result of the accident, the recoverable amount of Tilda is shilling 6.7 million. The explosion destroyed, to the point of no further use, an item of plant that had a carrying amount of 500,000. Tilda has an open offer from a competitor for shillings 1 million for its patent. The cash is already stated at its fair value, less cost to sell, net realizable, required. Calculate the carrying amount of the assets in 1 and 2 above as at March 31st, 2012, after applying any impairment losses. Okay. So number B1, now I'm going back. Number B1, they are testing for impairment of a particular asset. Okay. Number B2, they are testing for impairment of a cash generating unit. Okay. So number B1, they are testing you on impairment of an asset, individual asset. B2, they are testing you on impairment of a cash generating unit, which I'll remind you first before we do it. But of course, now that we are revising, you should be aware of how to deal with a cash generating unit. But before we do part B2, let's do B1. Let me explain B1 first. A company had bought an asset. When? That is 20 March 2010. I'm going back. Number B1. It says, B1 says, Telpath acquired a plant at a cost of 800 on 1st April 2010. That is used to produce pharmaceutical pills. The plant is estimated to have a residual value of 50,000 and estimated life of 5 years, neither of which has changed. Telpath uses straight line depreciation. On 31st March 2012, there was that thing that happened. A major customer, blah, 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 gave us information, whatever, okay? Then down there, we are given the cash flows for the next 3 years. Let me explain that. Yeah, let me explain that. We bought an asset here. We bought an asset, don't write. We bought an asset on 1st April 2010. That time, we projected that it will have a useful life of how many years? 5 years. Okay? Somewhere on 31st March 2012, listen, on 31st March 2012, one customer said he's no longer going to be buying our product, which has been manufactured by this plant. Okay? And we are even told, even before the customer came, we as a company, we also had issues with the machine. So we wanted now to know as a company, as at this 31st March 2012, as that asset suffered, that's the time we are testing for impairment. We are not testing for impairment on 1st of April 2010. Get the point there. We are testing at the time we sensed something could be wrong. That is when the customer came. We are even told, even before the customer came, we as our company ourselves, we had started sensing that this machine has issues. Okay? So now listen, meaning it will be required of us to calculate the carrying amount as at the time of impairment. We bought that machine for 800. That 800 was the carrying amount at the time of acquisition in 2010. I want you to get the facts. But we are not testing for impairment in 2010. We are testing for impairment as at the time we sensed something, which is 31st March 2012. So you need to know what is the value of that machine as at the time of testing. What is the carrying amount? We are told, yes, the cost was 800. Don't forget. But we are also told it had a residual value. It had a residual value of 50,000. That's what you can also call the scrap value. And a useful life of 5 years. Meaning, we need to depreciate it for how many years? From 1st of April 2010, that first year must have gone on until 31st March 2011. Year 1 ikaisha. The second year must have begun on 1st April 2011, then to go on until 31st March 2012. So it means, listen, we have so far used the machine for 2 years, then something happened. Okay? We bought it in 2010, April. This question is for the year ending March, end of March every year. Okay? So first year must have gone on until 31st March 2011. Second year must have gone on until 31st March 2012. That's the time we tested. Okay, we want to test. Now listen, that's why, having used the asset for 2 years, that's why they gave you the future cash flows for the next 3 years. You remember, they have given you only cash flows for 3 years, not for 5 years. Because we have already used the machine for 2 years. The useful life initially was 5 years. But by the time we are testing for impairment, we had already used the asset for 2 years. Now we are only remaining with 3 years. So that's why the examiner is giving you expected cash flows for the remaining 3 years in the question. Okay? Good. So that is the facts of the question, and I hope now you can get what the examiner is trying to derive at. So first we compute the carrying amount. That's not given. Then we now determine the recoverable amount. Get it? To get the recoverable amount, I've told you, you compare two values. 1, net realizable value. 2, value in use. Listen, we are told that there is nowhere we can get somebody to buy this machine. We are told in the question, there is nowhere we can get somebody to buy this machine. So automatically, the net realizable value is 0. Then we shall now use those future cash flows to compute the value in use. Maybe it will be 200,000. Whichever of the two is what we shall pick to become the recoverable amount. I hope you are now getting the concept. Good. Fine. So let's now start by computing what is the carrying amount. What is the carrying amount? Good. So let me now continue now and start. I hope you have managed to get the concept behind the question. That is the concept behind the question. So you can even put down, this is handout illustration. Handout illustration. I've said there is a very similar question in your past paper. I think November 2020, if I can remember. We did it in the normal class. We did it in the normal class. That's what we did. But I have said this one is more detailed, especially for the cash generating unit. It was more detailed than the one which came in your exams. Okay, good. Now, so let's now determine the carrying amount. Let's first get to this. Let us get depreciation charge per annum. Depreciation charge per annum. We are answering B1. Sorry, we are answering B1. First, we get the depreciation charge per annum. We know it is cost minus residual value. Divide that by the useful life. You divide that by useful life. Okay? Of course, in years. That is normally the formula for straight line. Whenever you are not given a percentage, whether they tell you 20% on cost, 5% on cost, and so on. If they just tell you straight line, you normally take the cost of the asset, you minus the residual value, and then you divide that by the useful life. So what is the cost of the asset? We go back to the question. The cost of the asset, we are told, when we acquired it, I hope you can see it there. We are told the cost of the asset was 800 there. That's what we are given as the cost of the asset. That 800. Okay, good. Yeah, that 800. Then we are given the residual value here. That is 50,000. Okay. Of course, the estimated useful life we are given as 5 years. Good. You know the cost, 800. We minus the residual value, 50. So I take that 800. I minus the residual value, which is 50. I divide by the useful life of 5 years. So every year, what becomes the depreciation charge per annum? What becomes the depreciation charge per annum? Let me multiply those. So this is 800 minus 50 divided by 5. So every year we are charging 150,000. Good. Now we can determine the net book value. Let's determine the net book value. Or we can even say this, determination of the carrying amount. Determination of the carrying amount as at 31st March 2012. That's the time we are testing for impairment. Determination of the carrying amount as at 31st March 2012. So the cost is, this is the same as net book value, by the way. This is the same as net book value. We know how to get the net book value. It is cost minus accumulated depreciation. Cost minus accumulated depreciation. Our cost is 800,000 minus 150,000. Don't forget we have already used it for 2 years. That will be 800,000 minus 300,000. So the book value by the time of testing is 500,000. That is the carrying amount. So we know now the carrying amount. What it remains is to get the net realizable value. what remains now is to get the net realizable value. Finish. Want to get the net realizable value and to get the value in use, so that we compare the two, we get the value at the recoverable amount. Good. Now, I hope you still remember, we have been told the asset cannot be sold. We can't get a buyer. So there is nothing to calculate there as the net realizable. Otherwise, I've told you, listen, to get the net realizable value, you normally take the selling price minus any cost to sell. But this one, they told us that it can't be sold. So the only working we are remaining with is to determine the value in use. Okay? Let's determine that value in use. Andika somewhere determination of the value in use. Determination of the value in use. We have been given the projected cash flows for the next 3 years. Okay? And we have been given the discounting factors. This time you don't have to calculate them. So let's have the table. You need to have a column for the year. You need to have a column of the cash flows. You need to have a column of the discounting factors. You need to have a column of the present values. Okay? So our first year, we are in the second year, which will go on until 31st March 2013, 2014, and 2015. Those are the future cash flows. Remember, I told you we had already used the machine for 2 years. That is 2010, which went on until 2011. Then we used the machine for 2012. So we are remaining with 3 more years. So for those remaining 3 years, what are the projected cash flows? Get the present values for them. Okay? Now listen, we go to the question and pick what are the cash flows that will be generated. We are given by the table down there. That we expect to generate cash flows by 31st of March 2012. We expect to generate 220. The other one, 21st March 2014, we expect to generate 180. The other one, we expect to generate 170. Then the question goes on. Listen to the next part. On 31st March 2015, the plant is still expected to be sold for its estimated realizable value. Good. Let's use those cash flows now. So year 1, 220. Year 2, 170. No, 180, sorry. That is 220. Let me put the figures in full, because even there we have used the figures in full. 220, 180. Now listen carefully. Listen carefully. Listen carefully. This is where the tricky was. Listen. Your past paper, I've told you, listen. The question that came in your past paper was slightly easier, because it did not have this concept I'm explaining now in the next point. In the third year, listen, we are given a cash flow of 170. I want you to listen. But is that the cash flow we shall discount in the third year? The answer is no. I would have asked you to give me the solution, but because of time, that's why I am giving you. Otherwise, I would have given you the challenge, because we are revising. Listen, when I was discussing, listen here, when I was discussing how to determine the value in use, I told you the accounting standard identifies 3 components of cash flows that should be discounted in the determination of the value in use. Number 1, we said it is any cash inflow that will be generated from the continuous use of the asset. Number 2, any cash outflow that will be necessarily incurred in the process of trying to generate more cash inflow. I gave you an example of maintenance cost. Okay? 3, any cash received or paid at the end of the useful life due to the disposal of the asset. Are you there? Good. Now listen. So for this question, unlike your past paper question, they did not test the past paper question. They did not test something to include number 3. But this question has tested us on something to do with the cash flow at the date of disposal. Listen. So the trick here was, how much are we expecting will be the cash flow that will be generated in the year 2015? Listen. From that year, when we shall use the machine, we expect to generate 180. Listen. But it is the same year that we expect to dispose that machine. And we are told it is expected to be sold for its realizable value. You remember the realizable value was how much? Which was the same as the scrap value here. The scrap value here was 50,000. Listen. So in the third year, the trick here was, in the third year, the examiner for this question wanted to see how much is the cash flow that will be generated in the third year, or how much will you discount as the cash flow that year. It will be 170 plus the 50. That's the point. 170 plus the 50, which will automatically come to 220, which will normally come to 220. You think you'll forget? Maybe you can put in bracket 170 plus the 50. That 50 is the residual value. Okay? At the time of disposal, the machine is expected to be sold for its realizable. That's the key point there. The machine is expected to be sold for its realizable value. Good. That was the trick in part the last year. I've said in some of your questions, listen, that part of the asset is expected to be sold for this much at the end of this life. That part is not there. Listen, in the past paper questions that have been brought, they only give you the cash flows that are expected to be this. Good. You just discount them. But this question, there is that small component that the examiner also wanted you to remember, that there is another component of the cash flow that should be discounted. Listen, from this question, and even from your past papers, they have no cash outflow. Remember, there are 3 components that to get the value in use. One could be cash inflow, which are the common ones. Cash outflow, which I have not seen a question including it. Okay. Third item is cash received or paid at the date of disposal. This question has it. Some of your past paper questions, no, in fact, the past paper questions don't have that third component. So most of your past papers, they just give you the cash inflows that are expected to be generated. Nothing like cash outflow, nothing like cash received on disposal. Okay? But this question, I hope you are getting my point. This question is including the cash received on disposal of the asset. Good. Then they have given you the discounting factors, but I've told you if the examiner did not give it to you, the formula is 1 plus r, the power of negative, and you should confirm that they give you that. If they don't give you the factors, that is the formula. Okay? But this question gave us the factors, so we don't have to recalculate them. We were given the factors down there. Year 1, it is 9.01. Let me quote it. 0.91. Second year is 0.83. 0.83. Third year, it is 0.75. Good. Let's do the calculations now. Let's do the calculations now. What becomes the present values of these future cash flows? I take that to 20,000. I multiply that by 0.91. I am getting 200,000. 200. The second one is 180,000 times 0.83. That gives me 149,400. 149,400. Finally, I take that 220, multiply that by 75, 0.75. That gives me 165,000. Good. Then we get now the value in use. Value in use. Let me add those now. So this becomes 200,000, 200 plus 149,400 plus 165,000. I'm getting an amount of 514,600. 514,600. 514,600. Okay? Then now, we use that now. Listen, we have been told the machine did not have a realizable value. So I want you to put down this statement after you're through copying the table. After you're through copying the table, I want you to put down this statement. Remember, I was supposed to compare two values to get the recoverable amount, but one of them is not there. It is a 0. Sema hivi. Below that state, below the table, you can see this. Since the plant did not have a net realizable value, since the plant did not have a net realizable value, then its value in use, shillings 514,600, its value in use, shillings 514,600 becomes the recoverable amount of the plant. Becomes the recoverable amount of the plant. See it? Since the plant did not have a net realizable value, then its value in use, shillings 514,600, becomes the recoverable amount. Becomes the recoverable amount. Good. That is what we have there as our recoverable amount. 514,600. Now we have not even answered the question. The question wants us to know whether the asset has suffered. Let's now answer the question. Listen, I want to know whether the asset has suffered. How do I know? We have agreed there is only one condition for an asset to be said to have suffered. If the carrying amount of the asset is higher than its recoverable amount, then we say the asset has suffered. Only if the carrying amount is higher. So for this question, now we want to compare those two. Let me remind you, we computed the carrying amount up here. We computed the carrying amount na tukapata this 500. That's what we got as the carrying amount. Now we have computed the recoverable amount. Tumepata 514,600. So I want to believe that you can already see, hope you can see that we can already see this machine or this plant has not suffered. Are you there? It has not suffered. Why? Because our carrying amount is less. It's 500, while the recoverable amount is 514. Maybe in conclusion down there, put down this statement. Put down this statement in conclusion now. In conclusion, you can say this. The carrying amount of the plant, is 500,000 shillings. The carrying amount of the plant is 500,000 shillings. And its recoverable amount. is 514,600. 514,600. The carrying amount of the plant is 500 and its recoverable amount is 514,600. Therefore, by comparing the carrying amount of the plant, with its recoverable amount, the plant has not suffered any impairment loss. The plant has not suffered any impairment loss. Good. The plant has not suffered any impairment loss. The plant has not suffered any impairment loss. So we are through with part 1, B1 of the question. I want to do part B2. That part B2 was for the cash generating unit. But before I do it, let me remind you the key issues when it comes to a cash generating unit. I hope you are through with part B1. I want to remind you the key issues concerning the cash generating unit before we do part B2 of that question. It is testing us on cash generating unit, but I want to remind you of the key points first. Okay, let me remind you, because we are revising. Now, as a company, let me first remind you, as a company, you have an asset. Let's call it asset A. That asset A has a carrying amount of 200 million. That is the carrying amount. As a company, you want to test whether your asset could have suffered an impairment loss. Listen. So you are supposed to compare this carrying amount with the recoverable amount. Listen. We have just said to get the recoverable amount, you get the net realizable value and you compare that with the value in use. To get the value in use, listen, you get the present values of what? Of the future cash flows. Now listen carefully to this. What if you as a company, this asset of yours on its own, it cannot generate cash flows. On its own, it can't generate cash flows. So if it cannot generate its own independent cash flows, then you can't get the value in use. If you can't get the value in use, then you can't get the recoverable amount. What do? You still want to know as a company whether your assets could have suffered. But the only limitation now is that this asset of ours, on its own, it cannot generate cash flows. What do you do when you have such an asset? Let me give you an example. You are a company called Magadi Soda Company. You have heard of it. This company normally has their own private railway line. They have their own private railway line, which they normally use to transport the soda ash from the lake to the factory. But let's take that railway line is this asset A. That railway line on its own, it doesn't generate cash flows. They just use it to transport the raw materials to the factory. But as a company, we want to know whether our asset has suffered. But it can't generate its own cash flows. What do? When you have such an asset, listen, then as a company, you are required to ask yourself, if I put this asset A together with other assets or in a group of assets, if I put this asset A in a group of other assets, then as a group, can they generate cash flows? For example, you ask yourself, if I put it together with asset B, which maybe has another carrying amount of 100, 200 million, will it be able to generate as two? Maybe I realize no. I put it together with another asset, maybe C, which has a carrying amount of 100 million. Then I ask myself, as a group of three, can they generate cash flows? As a group, can they generate cash flows? Listen, maybe I realize yes, that as a group now, they can generate cash flows. As a group, they can generate cash flows. So once I realize that group to which A belongs and which can now generate cash flow on its own, that group is what we call a cash generating unit. So you as a company, like you Magadi Solar Company, you had to first identify what is your cash generating unit in which this railway line belongs. Say, look for the smallest, listen, look for the smallest group of assets where if you put asset A in there, then as a group of assets, they can generate cash flows. We are not saying, another point is, listen, we are not saying that put asset A together with all the other assets of the company. No. Look for the smallest group of assets where if I put asset A in it, then as a group now, they can generate cash flows. So once you identify that group is what we are calling a cash generating unit. Okay? So now you compare the carrying amount of your unit, which is how much? 200 asset A, 200 asset B, 100 asset C. The carrying amount is 500 million. Okay? Then you now compute the recoverable amount as normal now. Because the asset can generate, the unit can generate cash flows. So it's possible to compare the net realizable value with the value in use. Because you can calculate the value in use now, generating cash flows. So once you compute the recoverable amount as normal, comparing the net realizable value with the value in use that you have calculated, blah, 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 get it. Let us assume that you get a recoverable amount of 350 million. Once you get that 350 million, you have to ask yourself, listen, as the unit, not the asset, as the unit suffered. Yes. Why? Because our carrying amount of the unit is higher than its recoverable amount. So we realize the carrying amount of the unit is 500. The recoverable amount is 350. So the unit has suffered how much? 150. Listen, once you now determine the impairment loss of the unit, once you determine the impairment loss of the unit, that loss should be allocated. That loss should be allocated to the assets in the unit, to the assets in the unit on the basis of their carrying amount. For example, how much out of the 150 will you write off against asset A? It will be 200, that's the carrying amount of asset A, divide by the carrying amount of the unit, 500, multiply that by 150. Against B, how much will you write off? B had a carrying amount of 200, divide by the total of 500, multiply by the loss of 150. That's how much you write off against B. Against C, it will be 100, that was the carrying amount, divide that by 500, multiply that by 150. That's how you write off against the assets in the unit. That we are saying, if a unit has suffered an impairment loss, then the impairment loss should be allocated to the assets in the unit on the basis of their carrying amount. On the basis of their carrying amount. Okay? Good. Then, now we went further. When we were discussing this topic in the main class, we said, what if now I'm developing, listen, what if one of the assets in the unit, and let us assume it's asset C, this asset now is an asset called goodwill. If your unit has an asset called goodwill, you still compared the carrying amount of your unit to be 500. You compared it with the recoverable amount of 350. Listen, you still realize your unit has suffered a loss of 150. But the only issue now is, now our unit has an asset called goodwill. I hope you remember when we were discussing this in the main class that we said if a cash generating unit suffers an impairment loss, let me reframe it this way. If a cash generating unit to which goodwill belongs suffers an impairment loss, if a cash generating unit to which goodwill belongs suffers an impairment loss, then that impairment loss should be written off in a particular order. I hope you remember that. That impairment loss should be written off in a particular order. What is the order? You are first required to write off any carrying amount of goodwill. First, eliminate the goodwill. That is number one. For example, like in our case here, the loss was 150 for all the assets in the unit. Then we realize, but one of our assets in the unit is goodwill, and it has a carrying amount of 100. So you take that 150, you minus 100 to write off the goodwill. That means you will be left with a balance of 50 impairment. Listen, once you get the balance of 50, it is that 50 now that you now allocate to the other assets, to the other assets in the unit on the basis of their carrying amount. Meaning, asset A has a carrying amount of 200. Listen, we have eliminated C. We have already written off C. C was a goodwill having a carrying amount of 100. We removed it from the 150 totally. So to come back in two assets, A and B, one having 200, the other one having 200. So the total is how much? 400. Multiply that by 50. That will give you how much write-off against A. Against B, there's a carrying amount of another 200. Divide by 400. Multiply that by 50 again. Multiply that by 50 again. Good. Are you there now? Good. So that is how you allocate. That's how you allocate the impairment loss of a cash generating unit to which goodwill belongs. First, write off the carrying amount of any goodwill. Write off the carrying amount of any goodwill. 2, the balance of the impairment loss should be allocated to the other assets in the unit on the basis of their carrying amount. On the basis of their carrying amount. Good. So let me take you now to part B of the question. They are testing on this kind of unit and even more. And even more. Listen. And even more. We shall identify those items that I'm saying even more. Then I'll compare with what we did in the normal class. I told you there's another question we did, I think November 2020, where they were testing impairment of a unit, cash generating unit, but it did not have as many issues like the one we have just read. Let me project back part B of the question we do it. Let me project part B of the question we first read it again. B2. We were told, or we are reading again, tell part owned 100% subsidiary Tilda Limited that is treated as a cash generating unit. On 31st of March 2012, 31st March 2012, there was a gas explosion there was an industrial accident, which is a gas explosion that caused damage to some of the Tilda's plant. The assets of Tilda immediately before the accident were, you are given that the unit had goodwill, patent, building, plant, and cash. All of them amounting to a carrying amount of 12 million. Down there, 12 million. Then they are saying, as a result of the accident, the recoverable amount is 6.7. That one they have already determined for you. Don't have to calculate again the recoverable amount. It's already calculated. Then the point is this, and this is the paragraph that I want us to get the point fact. The point or the paragraph says, the explosion destroyed to the plant of no further, the explosion destroyed to the point of no further use an item of plant that had a carrying amount of 500. Tilda has an open offer from a competitor for shillings 1 million for its patent. The cash is already stated at its fair value less cost to sell. Meaning, listen, the cash is already stated at its fair value. Meaning, you don't have to impair it. It is already at its fair value. So you will not impair any cash. Though it's part of the assets in the unit, you don't have to impair it. Now, listen carefully. In the past paper question, they had the first point, this one, where an asset was destroyed beyond further use. Your past paper question that I'm referring to at that point. But it did not have the second important point, where we are told that we can get from a competitor, we can get shillings 1 million from its patent. How will it affect our impairment loss? It will affect a lot. We shall see in a short while. Now let me explain. Don't write. Let me first explain. Let me explain. Listen. You have an asset or a unit which has a carrying amount, you can remember in the list. It was how much? 12 million. That one we have been given. Then we have been told the recoverable amount is calculated already at 6.7. That one we know. So if this is the carrying amount and this is the recoverable amount, then it is obvious the unit has suffered because the carrying amount is more than the recoverable. But we are told, listen, among the assets here, one of them called plant, which from the question, it has a carrying amount initially of how much? You can see plant there as a carrying amount of 3.5. Are you seeing it there? The carrying amount of the plant is 3.5. That's what they are giving us here. But listen, one of the components of that plant has been destroyed to the point of no further use. To the point of no further use. Meaning, it can no longer be classified to be an asset. You know by definition, an asset, any asset that a business has, it is normally defined, an asset is an economic resource. It's a something or a resource from which we expect to generate economic benefits. That's how we define an asset. It's a resource from which the company or the business expects to generate economic benefits in the future. So if one of the components of this plant has been destroyed beyond further use, then what is the examiner expecting you to do there? Listen, that asset that was destroyed can no longer continue being classified as an asset. What the examiner wanted you to do is to first remove it. You can't impair it. It's already destroyed. It's not an asset anymore. So out of 3.5 million, remove the 500. So you will remain with only the asset to suffer or to be impaired, 3 million. Are you there? Meaning now, I now get the new carrying amount after removing to be 11 point what? 11.5. I hope you are following. Now that you have removed that asset that was destroyed beyond further use, no longer an asset. Now the other assets now have a new carrying amount of 11,500. Then you now compare with the recoverable amount. You come and say 11.5 minus 6.7. That leaves me with a balance of 0, 0. I'm subtracting 15. That looks like 8. 10. That looks like 4. Listen. So our impairment loss is now how much? 4.8 million. Now listen. We have agreed that this impairment loss should be allocated to the assets in the unit. Then I've gone further and said, if the unit has an asset called goodwill, then I said this impairment loss should be written off in a particular order. Are you there? In a particular order. What did I say? First write off the carrying amount of any goodwill. First write off the carrying amount of any goodwill. So from this 4.8, remove the goodwill first. How much? How much is the goodwill? Let's go back to the question. Along the list, you can see, goodwill is given as 1.8. Goodwill is given as 1.8. Remove it. Are you there? Remove it. We remove that goodwill, 1.8. So we remove 1.8. Tunabaki na how much? 3 million. Listen, 3 million is the balance of the impairment loss. Listen carefully. Then I have said, this 3 million balance should be allocated to the other assets in the unit. To the other assets in the unit. On the basis of their carrying amount. On the basis of their carrying amount. Listen. The unit, maybe I can put it here. The units were goodwill, 1.8. Don't write. I'm just copying the list again that you see clearly. Patent. It is 1.2. Building. It is 4 million. Plant. You remember I removed the 500. So I'm remaining with 3 million. And then cash is 1.5. To give me now, listen, I have said, after writing off the goodwill, after writing off the 500 plant, so I remain with goodwill of 1.8, patent 1.2, building 4 million, plant, remember, was originally 3 million, 3.5, but one asset has been destroyed, then cash. Yeah? Good. Now listen. This is what I said is 11.5. I have told you, remove the goodwill first. That is the loss. Remove it. From the 4.8 impairment loss, remove goodwill. Listen. Then I was supposed to impair or to allocate the balance of 3 million to the other assets in the unit. To the other assets in the unit. Listen carefully. Already the question told us cash is already stated at its fair value. So it is obvious, therefore, that you should not allocate any loss for goodwill. For cash. Because it's already stated at its fair value. Now listen. Listen carefully. Now I'm remaining with three assets. Building and plant. To allocate a balance of how much? 3 million. Listen, I want to get the point. In the exam that came in November 2020, then the 3 million, I would have allocated it how? In the exam, I would have allocated it by saying, what is the balance of these three assets? 1.2 plus 4 plus 3, that is 7, 8.4. 8.2, sorry. I think so. Yes. Listen, 8 point. That is 1.24. Yeah, 8.2. So I've said, I want you to get the point. I've said, in the exam that came, that balance of 3 million, how much out of it will I have written off against the plant? It will be 1.2 divided by 8.2 times 3 million. Against B or plant building, it will be 4 million divided by 8.2 times 3 million. Against plant, it will be 3 million divided by 8.2 times 3 million. That's how I would have done it. Or, listen, for the question as per your past paper. Meaning, therefore, this will be how much? Very fast. Let me recalculate it for you. What will be the loss for the plant? For the patent? I'm not answering this question. I am trying to illustrate the past paper one before I bring the concept that I want to explain. So this would have been 1.2. I divide that by 8.2, multiply that by 3 million. So against patent, I would have written off 439. I would have written off 439. Okay? Meaning, after writing off, what is the new carrying amount? For the goodwill, obviously nothing because it's written off. Then it means for the patent, it will be 1.2 minus what? Minus 139. This will be 1061. Then against the building, I hope you are following, it will be 4 million divided by 8.2 times 3 million. That would mean I would have written off how much? 146, 3. Then finally against the plant, it would have been 3 million divided by 8.2 times 300 or 3 million. That would have been 1097. But I want you to get my point now. What I've done, I want you to get my point. Listen, what I've done like the past paper question. But this question, listen to this now. This question told us that we can get a buyer. We can get a buyer. Let me see. There's something wrong. There is something wrong in this working, and you have not even told me. Here, the new carrying amount is not 10. If the carrying amount is 1.2 and we are writing off 439, there is something wrong there. 1.2 for the patent is the carrying amount, old. If I minus the impairment loss, what will be the new carrying amount? Minus 439. Good. Sorry for that. This is 761. And that's what I wanted to emphasize. Now listen to my emphasis there. Listen carefully. If I go by the past paper question, this solution will be okay. But now we are going by the extra point that our handout question has added. Listen to what it added. This question added and said, from a competitor, we can get 1 million shillings from the sale of patent. If we sell our patent, we can realize 1 million. Meaning, in the market, our patent has a value of 1 million. In the market. Listen. If that information is not there, listen carefully, the books will now have a value of how much as the value of patent? 761. That would be the value that would have. If the additional information was not there, we would be carrying down a book value or a new carrying amount of 761. But that's where I'm saying, but one of our assets here, specifically this patent, we can get a competitor to buy it and is offering us 1 million. Meaning that the market value or the fair value of our patent is 1 million. The fair value of our patent. We may not sell it, but we know somebody is willing to buy it at 1 million. But we are not selling it. But he has opened us. He has given us an offer to buy it at 1 million. Listen carefully. You cannot, as a business, record an asset in your books at a value, listen, at a value less than its fair value. Anytime, even in fact when assets are revalued, they will normally revalue them to their fair value. So there is no way you can say in your books that I have an asset here which has a value of 761, but the fair value is 1 million. That asset must be revalued. Because you normally revalue assets to their fair value. Okay, that's the purpose of revaluation. So, I have said, if that information was not there, then we would be right to say our new carrying amount would be 761. But now we have an offer. Somebody willing to buy our patent 1 million. Listen. So in our books, it should appear in our books at least, listen, at least the lowest value it should be carrying is that fair value, which is how much? 1 million. That is what it should have. What does it imply now? Listen. What does it imply now? It implies that if the carrying amount is 1.2 and it has a fair value of 1 million, then the maximum loss it can suffer, listen, the maximum loss it can suffer is not 439 like I had previously here. I had indicated a loss of 439. But now it will not suffer a loss of 439 as it was supposed to suffer. No. It will suffer how much? If it has a carrying amount of 1.2 and its fair value is 1 million, then it means it can only go to the books, back into the books at the lowest value, which is fair value. You cannot show an asset that's a value in your books less than its fair value. No. Because assets are supposed to be revalued from book to fair value. So if the book was 761 initially, and now we are realizing it has a market value of 1 million, then the maximum or the minimum amount it should be reflected in the books is 1 million. Listen. So it means what? It means that this asset, the maximum loss it can suffer is not 439, instead is 200. Hope you are getting that point. This is where the tricky part of this question was. That the maximum loss should not be 439 for that specific patent. It can only lose a maximum of 200. So out of the 3 million we had balance, remove now 200 for the patent. Then utabaki na balance here how much? 2.8. Listen carefully now. It is that 2.8 million now that you allocate to the other assets now. Which are these other assets? These other assets now include the building and the plant. we are only remaining with two assets, building and the plant. Building has a carrying amount of 4 million, plant has a carrying amount of 3 million. So we are remaining with a balance of 2.8. So against building, it will be 4 million divided by 7. The 2 remaining have a carrying amount of 7. Multiply that by 2.8. It will give you whatever it will give you. For the building, a plant, it will be 3 million divided by 7. Multiply that by 2.8, whatever it will give you. Okay? Good. So that is the essence. We shall put down everything next time. We shall put down everything next time. You have no time to put down whatever I've said, but we shall put down the summary statement of all this. So the tricky was, 1, remove, listen, 1, remove the destroyed plant. The 500. I told you that concept was tested in your past paper also of November 2020. 2, I said, once you get the impairment loss, which was 4.8, allocate it to the assets in the unit. If the unit has a goodwill, first remove the goodwill. So from 4.8, I removed goodwill of how much? 1.8 million. That one is the loss. Okay? Then I remained with a balance of 3 million. Listen, I have said, if I was to go by your past papers, then I would have allocated that 3 million to the remaining assets on the basis of their carrying amount. I also told you this cash is already at its fair value. So I will not have impaired it. No. So it will go back in the books at fair value of 1.5. Okay. Then I would have remained with 3 assets: patent, building, and plant. So against those 3, I will have allocated the 3 million. Going by your past paper. Are you there? Good. But now we are saying, as per this handout question, they have added that extra information that we can get 1 million from the sale of patent. There is a competitor asking for it. So if it has a fair value or a market value of 1 million, then the minimum it should appear in our books should be at that value. Listen, I demonstrated by showing you, if that information was not there, then I would have carried my plant or my patent, at 761. But now we realize, yes, that would have been the book value after write-off. But now we realize it has a fair value of 1 million. You cannot show an asset in the books at 761 when it already has a market value or a fair value of 1 million. So you are required to bring it, the books at 1 million. So I was saying, then this plant or patent, the carrying amount now being 1 million, not 761. Therefore, the examiner wanted you to know that the maximum amount of loss it can suffer is not the 439 I demonstrated. It is the now 200. Why? Because it had a carrying amount of 1.2, but it should appear in the books at 1 million, so it can only suffer a loss of 200. It can only suffer a loss of 200. So once you know that, remove it from the 3 million. Okay? Once you remove it from the 3 million, you now remain with a balance of 2.8. That 2.8 now allocated to the remaining assets in the unit on the basis of their carrying amount. Are you there? Good. So I was saying, all that information we shall put down next time. We shall put down that information next time, where we shall summarize all that so that when you're revising, get the point clearly. Let's stop there for now. Pick it up from there next time when we shall now write a summary statement about all that information. That's why I told you this one was a bit tricky than the one of the past paper, because the one of the past paper did not have this issue of the patent having a fair value from a competitor of 1 million. But I told you the past paper question tested you on an asset destroyed, and then there is a component of goodwill in that unit. So you are just to reallocate the balance to the other assets, which was normal. Good. Otherwise, see you next time. Bye for now. See you next time. Bye for now.